Peers, the markets are closed. Interesting week it has been. We got some unemployment data. We got some news out of Japan. We got there's always news out of Japan. We also got to look at some crypto. We're gonna do everything today. This is gonna be kind of an all-inclusive look at the overall stock market and the macro. Uh, but yeah, this is Kevin, and you are watching Money Never Sleeps. Welcome back to Money Never Sleeps. As usual, guys, nothing we say is financial advice. Nothing I, J Webb, or House says is financial advice. We are just a couple of guys that love doing what we do, talking about the market, telling you our plays. But again, we can never advise you on what to do financially. Always consult with your financial advisor or just do your best research to make it your financial decisions on your own. That being said, glad to be here today. We obviously don't have anyone accompanying me. That's all right. We got tons of stuff to get into, and we're just going to take our time and get through all of it because it's going to be really interesting to talk about a lot of the data that we got this week, what we got this morning, and then we're going to look at pretty much a good overview of all of the stock market, crypto, and then maybe some of the bonds and currency as well. So let's start with unemployment because that was kind of the big thing that I saw this morning that I don't necessarily agree with, but we're going to take a look into it deeper because I do think that the numbers will get revised at some point in the future. It's kind of hard to look at things at face value and take them as face value when there are so many other conflicting signs. It seems like we're always taking one step forward, two steps back in this market. But right now, I got the unemployment summary on the screen. Take a look at this. We can see that total non-farm payroll employment increased. Let me just highlight this for y'all. About 200,000 in November. The unemployment rate edged down to 3.7%. So that's pretty interesting to see that, the unemployment rate edged down to 3.7% in November. The number of unemployed persons showed little change at 6.3 million. So in other words, you're saying that there wasn't much of a change across the board in terms of people who are currently laid off. Now, this is what I think is pretty interesting here. Among the major worker groups, unemployment rate for teenagers is at 11.4%, edged down in November. In other words, that's coming down from the previous month. Jobless rates for adult men, 3.7%, adult women. All these groups right here have little or no change month over month. But this one right here, among the major worker groups, the unemployment rate for teenagers, I think this one, the fact that it went down in November, kind of tells you that we are in the seasonality and seasonal positions that are coming back right now. Seems like there's always going to be a lot of kids that are going to find some part-time jobs at the mall or whatever is hiring for the time being, but that's no surprise there. I could see in some way that's kind of how the market is essentially saying that, or the labor market is coming in at not necessarily growing unemployment here. That's why they're saying that it's kind of saying no change at all in terms of how many people are unemployed. I could definitely see this impacting, the unemployment number a little bit. I don't necessarily believe that it's going to impact it that much. Obviously, there's some more other things that we're taking a look at too. The number of persons employed part-time for economic reasons decreased by 295,000 to 4.0 million in November. These individuals who would have preferred full-time employment working part-time because their hours have been reduced or were unable to find full-time jobs. Now, that tells me another thing right there that we need to be keeping an eye on because we're seeing it all across the board, 3.7%. That's the only thing people are talking about. We just saw that some people in right here, what was it, accounted for 295,000, decreased by 295,000. This tells me that a lot of people are losing time working because they are cutting hours, and that is not necessarily a great sign of growth. It tells me that, okay, there's a lot of people who are currently working out there right now that are working on projects or in sectors that necessarily aren't seeing a lot of work come in. I'm going to attribute this to manufacturing primarily. I think that that's probably going to be where we're going to see the most amount of contraction. So that kind of lines up with, maybe some unemployment expectations. I think we are going to see services sector begin to follow suit. We haven't seen that contraction in services yet. We will. I truly believe that it's going to be in the coming months. Manufacturing is always a leading indicator, and then the lagging was always the services sector. So keep an eye out for that. And again, we are in the seasonal positions that, the height of seasonal positions right now. This is the time where people are, being hired, and we're going to see this impact I guess, a little bit here in November as the season picks up, but I think the December unemployment rate is going to be really impacted by this. So we're going to have to see how that comes back. I don't believe that 3.7% is an accurate depiction of the current labor market. Maybe 3.8% flat even, that seems more feasible to me. But when we're seeing a number as big as 3.7, when the previous came in at 3.9, we know that there is a tendency for there to be revisionist economics in the months to come. So I'm not necessarily bought on this idea that we are actually at 3.7% unemployment. If it comes back 3.8, 3.9 in the next month or so, I wouldn't be surprised. It'd actually be a little bit more reasonable. But for this right here, I don't necessarily buy this. I think that this is a little bit. I think they're going to have to revise this at some point. Let's leave it at that. Total non-farm payroll employment increased 1,900 in November. Did I read this already? Employment growth is below the average monthly gain at 240,000 over the prior 12 months, but in line with job growth in manufacturing. Employment also increased in manufacturing, reflecting return of workers from strike. Employment in retail trade declined. Now, I believe that too. That makes sense too, that there are a lot of people who are coming back from strikes. We know that not just, obviously they're talking about manufacturing here, but we know that there was a SAG-AFTRA and all that stuff that was going on there. But all the automotive industry strikes that were going on, they did hire backs or allow some. They came up with the deals where it allowed workers to come back. So yeah, that makes sense, and that could be playing, part of its hand in manufacturing that's causing the unemployment number to come in maybe a little bit lower. But for the most part, I don't think that's even comparable to the amount of jobs that we did lose in November. So it's going to be really interesting to see how this does play out, because we are still seeing layoffs continue. I mean, even in the month of December, we saw Spotify recently said that they were going to be laying people off. And I believe I saw somewhere today that another manufacturer was laying people off. Let me just take a look real quick and see if I can find exactly where is this? Where is this? Bookmarks. Yeah, Matheson Trucking to shut down, resulting in 3,500 lost jobs. So another sign that the economy is slowing was when freighting and trucking, that industry starts to see significant decline. Well, I mean, if they're going out of business, they're going to lose 3,500 jobs. It tells me that demand and also just work in general is becoming harder to find, and that's not necessarily it's not a good sign for the economy going forward. So unemployment across the board. Do I think this number is accurate at 3.7? No, I think that we are going to see a lot of revisions in the months ahead, in the weeks ahead, months ahead for sure. And once we get out of December and kind of the seasonal positions do end, once we get out of the holidays, I think we're going to get a better representation of where we actually are in this market. It's going to be demand driven. I think that's going to be the most important thing. So if you don't see a lot of demand from the holiday season, probably going to see a lot less employees working come January, February, all the way into March, where I think we're probably going to start to see a lot more of contractions in the labor market that would make more sense in line with what we were thinking here on the show. Now let's go into some of the other stuff that we have here today. I want to talk about TradFi for a little bit, because today is the stock buyback window. It is closing. Actually, it's closed right now. It's 3:08. The market is closed. Take a look at what's going on over there and see how things shaped up and ended this week. Now we can see for the S&P, which I got on the screen right here, this is coming in at about 0.41% up today. It's almost $19 or 19 points that it shot up. Okay, I'm okay with that. It's really interesting when we look at this. This is the 4-hourly. Just bear with me when we look at this on the 4-hourly. But we were finding a lot of resistance on this white line here, and we finally broke through it today. And this is the first close that we got above it. That's the 4-hourly close that we got today is the first close that we got above that level of resistance. Now, we're only at 47 and 26 on the stochastic RSI, but if we look at this is not necessarily a sustainable move. I mean, this is very, very similar to Bitcoin actually in that type of parallel channel. So could it continue to push up higher? Yes, it just seems like things are slowing down a bit here. If you look at the volumes, they're kind of tailing off a little bit. Nothing too noteworthy in that regard. If you look at the Bollinger Bands. Bollinger Bands are kind of closing in. So that's something to keep an eye on. Let me just see if I can get this to be a different color. Let's pull this up here. What would be a better color? See if I can make this. Nah, you know what? Don't even worry about it. I'll just get rid of the EMAs so you guys can see it better. But yeah, the Bollinger Bands, that's the green that are coming in here, one here, and it looks like it's closing in on this level of resistance. So let's remove this resistance so we can see it better. And there it is. You see, when these things tend to close, we can expect that there's going to be a violent move, or at least a good move in one direction or the other. And you look at this on the daily, we were getting pretty close here. Obviously, we broke to the downside, but there's been areas where it's been a lot tighter and we saw more violent moves. Let me see if I can find a good one. Um, I would say somewhere maybe even further back. Yeah, I would say like right here. We're getting extremely close back in February of 2020. And then obviously you can see that we made the move to the downside. The levels of the top and the bottom bands definitely expanded until they started to contract again. And once they started to contract again, right around here in May of 2020, we saw that it started to push up, and it kept doing this where it's just contracting. Obviously it's within a channel, it kept going and going, but we're kind of seeing this contract right here. And I'm really interested to see what the next move is going to be for the S&P. I genuinely believe that we are extremely overbought on the macro timeframes. If you look at the weekly, it's at 96 and 86. That's gonna be a lot higher come Monday's open, because we don't get the data until Monday to see where that stands. The monthly, we're at 69 and 70. If December doesn't prove to be a month where we see any significant decline and we continue to hold our gains of where we currently are, we're only up 0.8% so far in this month. And, we put in half of that today from the market move, as we were up 19 points and we were only up about 36 points or so. It's really interesting to see, because that tells me we are not necessarily, creating bullish structure. And this month itself is kind of a sideways month. I think we're also seeing, let's pull up the volumes. Yeah, volumes are extremely low this month too. No surprise. A lot more of the volume came in last month, and then obviously in October, sell pressure, buy pressure. Now we're just kind of see people quietly going into the end of the year. Maybe they position themselves heading into 2024, closer to the end of the year, but this is when it starts to get really quiet in the market. So I'm not necessarily too concerned in that regard. But we can see that there is definitely some type of move that is going to happen on the daily moving forward. I would anticipate that it's going to be to the downside, considering how many gaps we've also created. We filled a lot of these gaps in the past. We filled that one here and here, but we have a gap here, gap here, gap here, gap here. And even if I go further into this, I probably could find one or two more gaps. Maybe they got filled already. Yeah, it looks like they did get filled. Okay. Yeah, so the majority of our gaps are to the downside. So that's where we know there is a lot of liquidity, and that goes all the way down to 4193 or so. So that's roughly 400, 500 points with a range from where we are currently to where we could go. Going to be interesting to see. Obviously 500 puts us down here, but it's probably going to be within that 400 point range where we start to see some of these get filled. Just something to keep an eye on. Now let's look at the NASDAQ. NASDAQ obviously is starting to see those Bollinger Bands tighten, getting really close to some type of move, whether it's to the upside or the downside. It's going to be really interesting to see. We did have this this bull flag that was building down here, lower highs and lower lows, eventually broke out of it. We went higher than this origin here. So that's showing me that we are definitely, we definitely completed this structure. I mean, we could go up a little bit further, but like I said, there's a few things that we need to keep in mind. One, this parallel channel, not this parallel channel, but this trend line that's coming all the way down from the highs back in December of 2021 to where we currently are. It's telling me that we cannot close above it. Every time we go to test it, we get rejected from it. And we're at 30 and 20 right now on the stochastic RSI on the daily. If we look at the weekly, though, yeah, actually, see, take a look at the 3-day. 3-day doesn't, there it is. There it is. It's loading. It's overbought. If we look at the weekly, it's loading a little bit slower today. There we go. 86 and 80. That's going to be higher today, or come Monday morning, because of what are we up this week? Up 87 points or so. It's still a good move. And we see here on the monthly, we're up 136 points, and we are at 84 and 84. So tech is still extremely overweight in my opinion. Now, if we look at the, Bollinger Bands on this, we need to start to see a contraction. So that would probably mean that we need to see some negative price action coming soon, where these jaws start to close in on that, find some resistance on it, and see what is the next move. The last time we were this high, obviously we got rejected in December of 2021. The jaws weren't closing on the monthly, but we did get close to where that is currently. So I wouldn't be surprised if we find some resistance on the upper band on this trend line and we start to move to the downside. We've also had a really good correction, the past 2 months, super green. I mean, November was 10% up. This month, up almost 1%. There's going to be a lot more price action to come, but that's what we're anticipating when we look at the TradFi front. So let's look at Dow real quick. Nothing too crazy. Still in that parallel channel on the monthly. If we look at this on the daily, yeah, our daily's a mess. Let's close let's close that and then just take a look at what's going on over here and try and make sense of this. You can see the stochastic RSI is extremely overbought. Let's get rid of this red trend line. We don't need that anymore because that's clearly invalidated. Let's get rid of this and let's get rid of this. So we just take a look at this clean view. And we know that 34,310 has been a key level of support and resistance for the Dow for pretty much this entire move in the market since 2021. So I'm going to get rid of that fat line and we're going to make it thinner so we can see everything. There we go. We're at the top level of this parallel channel. That's a really good move that the Dow has had recently, and it hasn't backtested anything. And you can see back here when we were moving up, obviously we had we shot up roughly 6% in the market, but then, we were met with 2.69% retracement. Now, that's not a huge retracement, but it's a good enough retracement compared to the move that we made to the upside. Now, from where we currently moved up back in October to where we currently are, the Dow is up 12%, 12.13%. Now, that's a pretty massive move without seeing any retracement. I mean, that's probably November 2022. That's FTX FTX, obviously I'm talking about crypto, but the October bottom back in 2022, that's a massive move that we had down there. And eventually we were due for a correction, right? So we came all the way down here. We put in a 22% move to the downside. And it wasn't until, October, we had that really good move where we're up 20% in November, right? And then we were met with another roughly 9% drop in March, which lines up with the banking crisis. So we've definitely seen a lot of volatility in the Dow, obviously other indexes as well, but we haven't seen what comes next. Everyone is saying we're in a bull market. We're going to continue to push up. As far as I know, these structures, these flags here don't necessarily tell me that we are in a bullish structure. It tells me that we are in a bullish channel, but it's a bearish flag 100%. Here's the pole coming down. And then here is your channel that you're forming right here. Now, very similar to the other ones, we have liquidity gaps that we have to fill. We got one down here, one down here, one down here, 1, 2, 3, 4, 5, 6 that need to be filled. I wouldn't be surprised if we fill all of them. I think we should fill all of them. But again, this might take, a couple of weeks to months to finally get to the bottom down here. If I'm looking at this reasonably, probably on the weekly, we're at 190. It's going to be at 100 and probably close to 100 come Monday. Wouldn't be surprised if in the coming weeks of Q1, we start to fill out some of these top ones. And once we get to some of these down here, obviously, I think we're going to be somewhere towards the end of January, maybe even middle of February, where we start to get to some of those. I think there is a huge problem that is facing markets and people aren't necessarily accounting for it. And I talk about it all the time, but that's liquidity. Liquidity is going to be probably the hot topic going into Q1, Q2 of next year. And, I'll pull up a chart from Fred. It's just showing you that there is liquidity draining from the system. And we talk about, we can even talk about consumer credit. That data came in yesterday and it was terrible. Let me pull that up real quick. But as I was saying, we're going to see a huge liquidity crisis, in my opinion, moving into Q1 of next year. And the reason for that is, tightening standards from banks when it comes to lending. They're increasing. So banks aren't lending nearly as much as they once were. And that tells me that, okay, now that they can't issue new debt, that means that there's not necessarily going to be money flowing in the markets. We talk about quantitative easing all the time when it comes to the markets in the Fed, but the banks have just as much of a role when it comes to that as well. So when I see people talk about, the Fed pivot and everything like that, that doesn't necessarily mean anything, in my opinion. I think that we have to remember that the banks are equally as much in play when it comes to the easing of the market as the Federal Reserve is, right? Let me just pull up consumer credit. I can't walk and chew bubblegum when I'm doing this, but consumer credit, we are looking at the numbers. Let me pull this up real quick for y'all. Stop that. We're going to go to Twitter and look at Stephen Geiger. Here we are. You can see that consumer credit came in at 5.13 billion versus 8.5 billion expected. The last print that we got was 12.25 billion. Now, this is where I was getting into the point where I think we're going to have a liquidity crisis. Now we're seeing that credit cards, the amount of debt that's out there is contracting. And that tells me that banks are not lending as much. Consumers might be maxing out their credit cards, and it's slowing a lot faster than we were anticipating. Now, a few months ago, we had a massive consumer credit, print. It was disgusting. It was. Let's see if I can even see it on this chart. This might not be have the numbers on there, but even the last print, 12.25 billion, that's a big number, but that's down $7.5 billion or so. Seven points, my bad, $7.125 billion from the previous month. Now that tells me a few things. Like I said, it tells me that the banks are tightening their standards when it comes to credit, how much people can borrow. It's also telling me that consumers themselves are not going out and buying nearly as much as they once were, at least not in the month of November. And it tells me it's probably going to be a pattern that we continue to see moving forward. If they don't have the money this month, they're probably not going to have the money next month, especially if rates continue to stay elevated like they are most likely going to stay elevated. So this isn't necessarily a bullish thing, in my opinion. And if we get back to what we're looking at when it comes to the Dow, we're probably going to see a lot of, where are we? I mean, there's a good chance that we could see that liquidity finally impact the rest of the market. And I was saying about these gaps down here, I mean, it could take a few weeks to fill out some of the first ones. But if we get into a roll where there's just like everyone scrambling for liquidity, watch out, because we could absolutely just fly through all of these real quick. Now, I've been saying a few times on Twitter that I think that we are due for a 1,700 point down day. And there's no merit to that number exactly. I'm just saying that we are going to see a massive candle to the downside. And I think the Dow is obviously the one that's going to see it more than the others. And it's just, it really depends on what day that comes. And I think there's a lot of things that could play into that. I think it's going to be more so less of a number that we're waiting on, like FOMC rate hikes, any of that stuff. That's CPI. That's not going to impact the markets as much. I think. I think if the market was more liquid, it would, but I don't think it's going to do that in this case here. I'm just going to pull up the Russell as well right now. Russell, seeing where this is, obviously this is no good anymore unless it's something different than I'm anticipating. But I think that if we start to see this market roll needs liquidity, then there's a good chance that we could be pushing further down faster than a lot of us anticipate. And this could be something that we just can't stop. And, I think it's going to be a day that we're not going to anticipate anything. And maybe it's a news story that we've been ignoring for months. Maybe it's something that comes out of Japan, one of these countries or nations that are absolutely having trouble with their economy. It's just something to keep in mind. We're pulling up the Russell just because I want to go through everything today, just because we got plenty of time, and then everyone can just kind of go back and see what we're talking about in all regards to the market. But I had a 5-wave move down here, and I had this is my wave 4. Obviously, that's not valid anymore because it went higher than the wave 1 initially that I was filling out. So kind of what I have to do is go a little bit bigger. So what I'm seeing here is maybe this wave 1. We're under wave 2 right now. That would make a lot of sense since the weekly is getting extremely overbought at 94 and 78. I want to see a good wave 3 to the downside, which would line up with what we're anticipating coming in Q1. Maybe a bit of a relief rally, but then we continue to push down throughout the rest of the year. I think that would make the most sense for me looking at this. And again, I look at the small caps; they're rallying a little bit because obviously they've been so compressed for a period of time. And it's kind of a weird thing with the small caps because if I look at this here, might be a bad. I might have drew that terribly. Yeah, I did. I drew that terribly. My bad. Pull this here, and then we can see. Let's go like this. Yeah, let's do that. You can see that it's kind of in this this falling triangle here, and this falling wedge. It's probably going to go the way that the trend is, and the trend was to the downside here. Now we're consolidating in this range. We broke back into it. If I'm right, and this is a wave 2 move that we got in this correction here of a 5-wave move, then obviously we're going to have a pretty violent move to the downside. We're probably going to lose 1631. That's, we'll put a little line right here. This is going to be the level that we're going to need to lose in order for this to be valid, in my opinion. Then we're going to have to find support somewhere down in this range. I don't think there's a lot of support necessarily. So maybe right around here, maybe 1455. So we'll draw another line there. And again, these things don't have to hold, right? It doesn't have to be like that. We could even come back up here and then just put in a little bit of a lower low, corrective pattern, another 5 waves down. It really depends on what we're seeing here in the macro as well. The way I see this right now, and this is just, eyeballing it, A, maybe like B somewhere here, and then C, corrective pattern, and then we would anticipate that it goes 535, so 5 waves down, the initial move, consolidation, 3 up here, and then obviously another 5 down. That's just one way to look at this. I could have the count wrong. I don't necessarily like this three-way right there. I'd have to draw it a little bit better, but something to keep in mind, because if we look at this on the monthly, once again, I think it's going to be it's not overbought. Yeah, no, we're not overbought on the monthly. However, do I think that the demand of some of these smaller cap companies that are publicly traded, ones that kind of show a better picture of where the consumer currently is gonna rally crazy? If they didn't even rally when everything else was rallying in this market, then probably not. I think that everything is going to be small gains for those small caps in the Russell 2000. So it's just something to keep in mind. Now let's look across the board. Let's move into the international markets. I'm spending so much time on TradFi, but whatever. This is important stuff. And we talk about the Nikkei. We're talking about all these gaps that the Nikkei has, and we're starting to fill them, guys. We filled up a couple of them already. At least one of them. Yeah, this one's been filled, so we can get rid of that. Actually, what I'm gonna do is I'm gonna pull this down. I'm going to move this down here because we actually formed a new gap down here. So that's probably going to get filled. Obviously, this is because there was fear that they were going to raise rates in Japan, and that pretty much sent the yen flying, and obviously that's going to take equities out. Now, this is a really interesting chart, and I want to go back a little bit even further, so I will pull up the monthly on this one. But if we look at the history of the Nikkei, they had a meteoric just rise, like from early 80s all the way till about 89. So they had a decade of just absolute economic boom and growth. A lot of that did come from, just a speculative bubble. I think a lot of this had to do with their property market in Asia at the time. They also had, money printing. So obviously there's more money out there, and then people were just buying like crazy. Eventually that bubble did burst in the early 90s, and that just absolutely tanked these assets. By August of 92, about 2 years or so after, we're down 63% in the Nikkei. And we got pretty close to those levels up here. I mean, is it possible we could still go up from 34 to 38, almost 39? Yeah, sure. It's definitely possible. However, there is some type of fear that is going throughout Asia right now, and different reasons for different nations. But when I look at the Nikkei right now, I think it's really interesting because we are kind of in a speculative bubble. It's been up only since the great financial crisis, right? The bottom of this entire move to the downside in the Nikkei was the GFC, January of 2009. And it just rallied for roughly another 10 years or so, which is no different than what happened over here in the speculative bubble of the 80s into 1989's crash of the market. So when I look at this here, we're getting to a point where everything's extremely speculative. They were gonna, start raising rates back in the 1990s. They're talking about raising rates here in 2023, 2024. 2024 obviously is when they'd implement it. But we're also printing tons of money, and we saw that the yen has just been losing value to the U.S. dollar recently. Once they said that they were going to do rate hikes, the yen pulled back against the dollar pair, so the yen got stronger, and then the dollar pulled back. That's what I meant to say. Dollar pulled back against that pair, and yeah, so very similar setups. And we do know that the wages in Japan aren't necessarily growing. And I did see this really interesting article out of Reuters. It's from a few weeks back, but I'll just pull it up here. Surging Tokyo property prices squeeze on young professionals. And it's really interesting when we think about this in another situation, is that we know that Japan's youth population is dwindling. We know that they're an aging population. They're not necessarily having as many kids as other Asian countries. That's going to impact their economy, because now we're going to have pretty much a society of elderly individuals who either are retired or just can't work due to age or health. And we're going to have a small population of youth that are able to pretty much sustain that economy and work, and just continue to to stimulate the economy in some regards. Demand is obviously going to be a huge issue, production, stuff like that, we're going to have to keep an eye on. So with all that being said, and what's happening in the yen market and the bond market in Japan, what the Bank of Japan's doing, their easy monetary policy, and the thing about also the 1990s bubble was that demand didn't matter. People had money, they didn't buy anything. And now that we have a population where the wages are going down, sure, there's a stimulus. There's a huge amount of money that's still flowing around in Japan and Japanese markets. Doesn't guarantee that they're going to need any of the things moving forward if demand dries up. So, I mean, we could be seeing another lost decade for Japan I hate to say that, but it's very possible. It seems like this is a very similar setup to what happened in the late 1980 late 1980s, 1989 year specifically, into the early 1990s. So it's just something to keep in mind. I think that there is a good chance that we could see this absolutely bleed out. And again, from where we are currently to that last gap, go actually from the top to that last gap that's down here. It's a 50% move. If I'm looking down here, this is where most of the support is. A 60% move. 60%. That's almost identical to what we were back in the 1989 crash to the bottom 65. So a little bit less makes more sense that it could stay a little bit higher above that. But we got some support that's built here, resistance. I think there's a good chance we can fill all these gaps in the coming years. I say years because obviously I don't have a crystal ball. I can't say that it's going to happen next year. By March, we're going to fill all those gaps. It's very improbable to say, but we can see how significant this move to the downside was. It was arguably just as fast to the downside as it was to the upside. So these moves are very violent when they do come. It's been kind of a slow grind. However, it's been pretty exponential recently. If we look at this on the monthly, I do have a feeling that if this does hold its resistance and we start to see more issues in Japan, there is a good chance that we could fill this out and we could be going to some deep lows in those markets, in that market. At least we could see it across the entire Japanese economy. That's what I'm pretty much saying. China, we're still keeping an eye on them. Let's pull up the EMAs. Got the death cross that's looming. We're not there quite yet, but we want to see if we are able to get that. It seems like we're going to get that because we are just so significantly below the 200 EMA. I'm not convinced that it's going to have a massive rebound before then. Even if stimulus, they continue to print stimulus in the Japanese economy, that's just going to impact the yuan, and we're kind of seeing that already. So obviously we want to see where we are. If we're below the COVID levels already. Is it possible that we could get below the GFC levels? I think it's very possible we could reach them fairly soon. Nothing is necessarily broken in the Chinese economy that is well known. Right, we don't have anything that's suggesting that they're an absolute economic fallout, even though there are signs of the property market being very troublesome for them. It would require another 35% move to even consider touching the bottom of the GFC. So that's something that's really interesting. But again, I was talking about the yuan. We can take a look at some of the currencies right now. The yuan right now is trading at 7.16 yuan to the US dollar. So obviously it was at 7.15 for a few days, and we're starting to see it kind of tick up once again. We're above the 200 EMA. Obviously, the 50 is sitting at 7.22. So it's interesting. We're filling this gap right here that was left from November 23rd into November 21st. But I want to see where this goes. We're extremely overbought on the daily. I don't know if we're going to get any pullback. There's a good chance we could get a pullback if we look at this on the 3-day. Looks like we got plenty of room to the upside. If we look at it on the 3-day, right, we want to test that 50 moving average here. And let's look at the weekly real quick. Yeah, the weekly looks like it's prime. So it's really interesting. In the short term, a lot of these currencies look like they're doing the opposite of what they want to do on the macro, right? So that goes for the DXY, that goes for the yen, and it also goes for the yuan and the euro in that regard. So when I'm looking at this, I'm anticipating that over the coming weeks to months, the yuan is probably going to retest the 730, 736 range, top of this parallel channel, right? Could it go higher? Yes, it absolutely could. We could actually see a bit of a spike even above this because just global demand, if it comes down that they need to pay off debts, likely the US dollar is going to continue to be the outperforming asset of the Forex market. Now, if we look at USD, JPY, we had a really good move to the downside yesterday off the talk of rate hikes in Japan. The market speculated, or anticipating that the yen carry trade might be unwinding and they were going to take their money out of the U.S. markets. Obviously, a ton of U.S. debt was offloaded yesterday, even today, and they were going to move it back into the Japanese markets. Let's be patient on this. We don't necessarily have word that the BOJ is going to do anything. We know that they love their easy monetary policy. So nothing that we can get too excited about just yet, but I do want to talk about this. We wicked all the way down to 141, and we're currently sitting at 145. It's about to be 145 on the USD JPY. So in the grand scheme of things, from where we dropped it from that bottom of the channel on Thursday, top of the move to where we currently are, it's only a 1.61% move. Right. So that puts us where we were at 147. We're at 145 right now. Tells me that there's a good chance that we could be back in this parallel channel and continue trading it. I think this is a bit of a flash crash. What happened? That was just speculation. interesting to see what happens moving forward. But if we found support on this 200 EMA, if we were able to get back in this parallel channel and we're able to get above this 50 moving average, Bank of America said earlier today, and I kind of agree with them, it's a good chance we could be seeing the yen to the US dollar is 155 yen to one US dollar. And that would pretty much make sense, right? We know that even if they're dealing with inflation over there and they're trying to raise rates, obviously that's going to impact their equity market and it's going to try and strengthen their yuan. If global demand for the not the yuan, global demand for yen is not there, obviously that's not going to really help in either situation. It's not going to help the Japanese people. It's not going to help the Japanese economy. It's just not going to be beneficial. So very interesting to see there. And then again, last thing we'll talk about here before we get to some of the other stuff, we look at stock markets and crypto, and then we can call it a day. Let's look at the Euro USD pair. Now, no tons. All right, let me just get rid of some of this shit on here because this is kind of wild for everyone. But we could see for the most part, we broke out of this massive bear flag, putting higher highs and higher lows. And we had a good move to the downside. We're finding support right here on this 50 and 200 EMA. Looks like they're about to give a death cross here. I can't be certain where it is. Yeah, obviously it's on the red right there, so it's kind of hard to see. Let me see the 4-hourly. Yeah, that doesn't help one bit. Yeah, so if we look at this, we're seeing that on the stochastic RSI, we're extremely oversold. We're at 0.25, 0.17. I'd anticipate that we have a bit of a bounce that's kind of finding support on the 50 and the 200 somewhere here. It doesn't have to be significant. Maybe it comes up to 108, right? It just needs to be a three-way move to the upside that we would anticipate before we have a further collapse to the downside. And I think not a lot of people are talking about the euro going back to parity with the dollar 1-to-1, but it's very possible we continue to see that. And now, which situation are we going to see this in? Well, obviously, the U.S. equity market needs to sell off. And we know that the stock buyback window did end today. So they're not going to see as much positioning to the upside and hedge funds chasing if there's no one necessarily buying some of those big corporate stocks. So that tells me that we could see a bit of a sell-off, and the sell-off itself could benefit the dollar moving forward. And we can see that this little bounce here could be met with that fall in the equity market, which we're anticipating in Q1. So maybe this goes into the end of the year up, and then we start to tail off towards the end of the year. And then over the coming weeks and months into Q1, Q2, we could start seeing global demand for liquidity increase. Obviously, the dollar is probably going to gain against the euro in that regard, and we could start seeing this come down. It just lines up with a lot of what we're seeing, on the weekly. Extremely overbought on the weekly for the stochastic RSI, on the euro USD pair, and on the monthly, once again, extremely overbought. So I do think that this thing is going to fall to parity with the US dollar. I deleted this, but this is a parallel channel once again on the macro. Excuse me. And we can see that it broke from it. It retested it, broke from it, broke into another parallel channel, broke from it. Now it's probably going to try and retest. I'm seeing pretty much just lower highs and lower lows. Eventually, this is going to break to the downside with how overbought we are. I don't necessarily think it's going to be pushing up. We're under the 200 and the 50. If we weren't able to break over this on the monthly, probably aren't going to be able to break over this moving forward as well. So really interesting stuff on that front. I would anticipate that the euro at some point in Q1, Q2 is at parity with the US dollar, and maybe we were even tackling the bottom of this channel, or bottom of this move, which is about 95 $1 is equal to 0.95 euros. So obviously the dollar would have the upper hand in that regard too. Okay, a lot of stuff that I talked about there. Obviously the dollar, just real quick, it was in this bull flag, coming down, lower lows, lower highs, shot up. We keep testing this 200 EMA. We're having trouble breaking this. It looks like it's going to come down in the short term. But again, complete opposite is everything else in Forex is doing. It's extremely oversold, right? And we're in this parallel channel. We got to see, we didn't close above the 50 moving average on the weekly, which is unfortunate. Actually, there's a little bit more time. We could see something in the Forex markets push it up just a little bit. We'd have to get them over 104.02. We went as high as 104.263. And this is, again, after everything that's happened with the JPY. But I do think that we are seeing this 100% as a response to the equity market starting to rally. But eventually we're going to start to see global demand for the euro dollar and other assets that are more risk-free. That's definitely going to impact the equity market, and this is probably going to go up. So looking at this on the macro, nothing has changed for the dollar. I'm still bullish on it. Could we push down a little bit further? Absolutely. On the daily, we need to see that correct. I would be interested to see how this opens up on Monday or Sunday night, my bad, because that would give us an idea of where we are. Probably going to be fairly over, still in the overbought territory. So we could push down a little bit further in that play. But other things that are important in the market, obviously the yields. We're seeing the yields go back up again. That tells me that people are dumping bonds, dumping U.S. debt. Not a good sign. I don't think the Fed's going to like, or not the Fed, but the federal government in general is going to like that. So we're kind of range bound. We're probably going to see if we can test between these two here. I wanted to see the short end of the curve continue to decline just because that's going to give us the most amount of normalcy in the market. We need the long end of the curve to get back to the higher level of yields and the shorter end, obviously, to fall below those to stabilize. It's not going to prevent a recession, but it's definitely going to bring some normalcy back into the market. But yeah, US debt's obviously dropping. I think a lot of that has to come with the yen. If we look at gold here, gold is really interesting too because we had a day where we went under 2000. So we were roughly at 1995. It's a good move to the downside. Looks on the daily, we could push up a little bit here. But again, if we look at the weekly, complete opposite. So it seems like across the board, short-term time frames aren't necessarily lining up with what's on the long term, the macro. And that's something we have to keep in mind because I think a lot of people are getting really short-sighted here. And when I talk about the daily and stuff like that, that's something that could play out over the course of the next, 2-3 trading weeks, take us into, 2024. And come 2024, everything could be extremely overbought again. And now we're just pretty much in a place where, okay, who wants to be playing hot potato and buy the top of this move? So yeah, and again, you could be trading this, you could be going long on this stuff into the end of the year. It's very possible. I'm personally not. I can't tell you what to do, but there are signs there that are telling us that there is some momentum to the upside. I just don't want to be caught holding that hot potato at this point. I think that there's been a significant rally from late October and throughout all of November to where we currently are, and it seems like time will eventually run out given what the macro is speaking to me. Okay, got through all that. Now, there's some other stuff we do need to cover, crypto, and I know that's probably what most people want to see here. And let's go across the board and just start with Bitcoin, and then we'll look at some of the altcoins that are going crazy, and we'll call it a day because we are definitely making this one a little bit longer today. But no fear, here we are. This is Bitcoin on the chart. You can see that it is up 2.64%. Once again, we're up $1,156 on the day. Guys, it's nothing I can tell you other than this is arguably the same thing we saw a month ago. Obviously, Tether and CZ and FDUSD, TUSD, all these stable coins and exchanges, Kraken, Bitfinex, Huobi, USDC, even to some regard, play into effect where we're looking for liquidity and pushing the markets up higher. I mean, CZ, the day, a week before the day he was arraigned in the United States, not even arraigned, but just pretty much brought in Seattle, and they booked him on charges and stuff like that. That guy had printed an insane amount up to that week, and that was the bottom of the USDC drain, right? They talk about this quite often. Now, where we are currently with CZ and his position, his predicament is he's not allowed to leave the United States, right? He's staying in the U.S. until his hearing is it's going to be interesting because now they can monitor him in the United States. He can't obviously warn anybody of anything. He has probably no communication or very little communication to the outside world of the United States, where he can safely say something without implicating him and making his situation much worse than it currently is. This is just speculation. This is not fact. If that's the case, then it makes a lot of sense why we're seeing a lot of transactions on Tron that seem kind of fishy, a lot of hacks and stuff like that. I don't believe that they're hacks one bit. I'm calling Justin Sun out for bullshit on that. The amount of hacks that have happened so recently and the price continues to fly up. And I mean, if we just look at TRX USDT, some Binance, it's still relatively high, guys. I mean, this thing has just been pretty much up only since FTX. I mean, there's been no retracement whatsoever. And this one's been one of the better performing assets post FTX too, right? Let's grab this and go up here. It's up 133% to the current levels, and the high was up 147%. So, I mean, Tron is very, very, I will say it, fishy. And that's just my opinion. When we look at this blockchain, we did the, on-chain analysis of this prior to CZ being caught and stepping down as CEO. But when I look at this across the board, I think that we are in a pretty scary place. I think that there's going to be a chance that we are going to see a bit of a run on stable coins. We are going to see a depeg, and primarily it's because half of Tether's market cap is on the TRX blockchain. So with CZ being away, SBF obviously, sentenced to, go to. He's going to get sentenced fairly soon. I can't remember the exact date, but at that point, who's to say that we're not necessarily going to see some complications from sanctions against, the Tron network? We know that Tron network has been the network that has the most amount of transactions that the U.S. government is currently looking at. We know that a lot of the transactions on Binance, even the ones that we've been watching on Whale Alert and Whale Watcher, that were coming through in October and November, the USDT mints and prints and sent to exchange to exchange, it's all on the TRX blockchain. So if it comes to the point where they're going after Justin Sun and they're going after Tether, I mean, that's half of the market cap of USDT is gone. That essentially that would mean, I'm not saying half of crypto's market cap is gone, but that's definitely going to complicate a lot of things moving forward, right? So that also means that there's probably going to be depegs, and if there is depegs, if there's more supply than demands, that means if you're selling on the exchanges, because I don't anticipate most people to be selling on the Tether Treasury, there is a great chance that you're going to start to see those values drop significantly, worse than USDC's back in the March banking crisis. So yeah, this is definitely stuff that we need to be keeping an eye on. And, I think that what they're doing right now is they're doing a mass print because they do anticipate that there is going to be some type of legal action moving forward. I think people are underestimating what BlackRock said already. They're anticipating this ETF to get approved, but the problem with this ETF is the stablecoin industry. There's the two stablecoins that are out there, USDC and USDT, obviously the two big ones. It's very easy to manipulate the market and Bitcoin's price with these. We've seen it across the board, pretty much the entirety of November up until Thanksgiving. Even so, no, I mean it's hilarious. I mean, I don't think anyone's keeping an eye on this, but if you look at USDT's market cap, it's at 90 billion, and it keeps climbing, right? So they're definitely still printing Tether. Where we were with Thanksgiving, I can't remember the exact date of Thanksgiving. Let's say the 21st of November. That's 88 billion, 88.3 billion or so. No, my bad. That is, where is it? Right here. That is about 87 billion. So between then and now, we're up about $3 billion, almost $3.5 billion from that move from Thanksgiving. And the price continues to go up, and so does Bitcoin's price, and so does most coins out there in the market. I think a lot of retail is obviously buying the top. If we look at some of these alts, let's take a look at Cardano today, which is just absolutely insane. Look at that. I mean, it's up 19.96%. I think earlier in the day I saw it was up 26% or so. Yeah, 26.46%. So insane numbers there. Does that make a lot of sense? Sometimes I think Cardano does move exceptionally well when it does move. But again, when it does move, when is the keyword in that phrase, because Cardano doesn't move hardly ever. But it's moved significantly. If we're looking at this here, this is some type of ABC corrective pattern. For it to be invalidated, in my opinion, we got to see this stay below 71 cents. I mean, that's a huge range here. I think this is a bit of a blow off top. I don't necessarily agree that it's going to go much higher, but you never underestimate the possibility. I'm looking at BNB right now, obviously hitting 239, still within this parallel channel, which is up here. Actually, no, it's not in that parallel channel. It's down here. It's below the 200 EMA, above the 50 on the daily. It's extremely overbought. Weekly, extremely overbought. I'm not too worried about BNB. Obviously, that's going to come down to Binance whenever they sell. That's going to be when this moves. But yeah, 200 level, they're going to continue to protect. So like it's Solana. It's going for that $75 mark. That's a level that I thought that we had a good chance of hitting. That finds some resistance right here at 75.58. And the weekly, it's extremely overbought. On the daily, it's going to be extremely overbought too. So, a $3 move here, it's very possible for us to hit that. Macro wise, if we're looking at this on the weekly, what are we looking at on the charts? It's very complicated. I think this is a wild chart. I mean, I could say 1, wave 2, 3, 4, and then we could still come back down here. It could be something like that, right? And this could be this could have been a 5-way move here, and we could see something like that. I don't like that one though. I don't like how charts look when they look like that, but there's definitely something here that we need to keep an eye on with Solana. But I think that as long as we stay below that 75 75.5 level, there's a good chance that this is just a wave 4, and we still have to wave 5 to continue to push down from here. And again, what would that entail? That would entail us going pretty deep, right? I still think that we are going to put in a lower low for Solana. I think it really does come to liquidity. Now, the question is this manipulated by any way by FTX, maybe market makers who got burned from FTX's collapse? It's another thing you have to keep in mind. So I'm not going to get too married to the idea that this is going to tank significantly. I would like to see it down here for just, technical analysis, and it'd make a lot more sense. But I do not understand that right now crypto is an extremely, extremely fraudulent market. And I wouldn't be surprised if the market moves in certain directions that aren't necessarily logical or the most likely or most reasonable. So remove this Matic. We're just shy of 90 cents. It seems like we're going to get a bit of a top here, or we're going to push up a little bit higher, make a higher high. We could be above $1 if that's the case. And we've seen how Cardano's moving. So the markets are moving fast. 1.6 trillion here. Let's see this. Yeah, we got a massive move to the upside today in total market cap. So this is going to complicate things a little bit. Is it? No, this isn't going to complicate anything at all. This is still an ABC corrective pattern. ABC, somewhere down here. But we can see that, we added 39 billion. That's pretty much Binance's entire market cap for BNB. So there's a lot of money that's flowing in. Again, I think a lot of this is elevated without backing. And to end this, I do want to talk about the last thing that I'm seeing here, which is, we were talking about BlackRock a few minutes ago, but let's look at BlackRock and the SEC, pretty much what they've been talking about for a period of time. I'm going to read what proof of reserves means and why there's not going to be any ETF until Tether or Tron or any of those blockchains that's kind of facilitated in those exchange coordination, or where we've seen either funding to, terrorist groups or criminal groups, or, just in general, moving money back and forth without, in a fraudulent way, so laundering or washing. So I'm not saying anyone is committing fraud. Obviously, I don't have any proof to say that, but we do know that there is some of these exchanges happening on exchanges and also some of these blockchains. So let's take a look at this. If you haven't seen this before, this is I'll share it on Twitter so you guys can take a look at it. But this is from the SEC, and this is the investor.gov. This is talking about proof of reserves, right? And I just want to read this through, and then we talk a little bit about what we're seeing here. Proof of reserves is a term crypto assets. Proof of reserves is a term crypto asset entities, including trading platforms and or entities that issue crypto asset securities, use to describe voluntary method for offering evidence that the aggregate entity has sufficient reserve assets to cover what is held for customers and their accounts given at a point in time. Crypto asset entities may be offering these types of assessments as a way to satisfy customers that their funds are safe or safeu and available upon demand. However, these types of services may not provide any meaningful assurance that these entities hold adequate assets to back their customers' balances. Further, crypto asset entities might use these in lieu of audited financial statements in order to obscure and confuse customers about the safety of their assets. For example, proof of reserves typically may only approve a snapshot of what is, for example, held by an entity, and certain wallets or accounts are backing customer assets as of a certain point in time, may not disclose management's activities during the period of these snapshots. For example, the use of customer crypto assets in crypto asset lending or other activities does not tell customers the whole story about the entity's liabilities, and, for example, whether the customer has to stand in line behind other creditors if the entity fails, and may not offer protection against the entity moving customer assets shortly after a proof of reserves is completed. In addition, I'll read this real quick. In addition, a proof of reserve is not as rigorous or comprehensive as a financial statement audit and may not provide any level of assurance. For example, audited financial statements typically require audits of complete set of financial statements performed by a registered public accounting firm in accordance to PCAOB auditing standards. With so-called proof of reserves, there are no specific audit requirements for the engagement or information reported, allowing an entity full discretion to manage the terms of the engagement. For example, actually, I don't want to read this anymore. You get the idea, though. And I'll put this on Twitter so you guys can read the whole statement. It's actually really interesting, and obviously there's more that's there than I can literally go into without boring the fuck out of everybody. But what I'm saying in this regard here is that, I keep saying that too, this is pretty much telling us that proof of reserves of these exchanges means shit, and we keep getting them from these exchanges. Binance was very guilty of this, of putting snapshots out, and then we'd see on chain that they'd move assets in and out before and after the audit snapshot was done. Audit. But yeah, I mean, this kind of tells me a few things. This tells me one, there is still warning that some of these exchanges are not liquid or solvent. And this is going to get complicated if this liquidity crisis does hit in 2024. With Binance, it tells me also that maybe funds aren't necessarily safe as people think they are. Obviously, CZ's gone, but we have to understand that there's a lot of money that's leaving Binance itself. We need to make sure that their liabilities don't, you know, their liabilities aren't greater than their assets that they are holding on hand, right? That way, people are able to freely withdraw any other funds from these exchanges, get their funds back. The other thing it tells me is that these proof reserves mean nothing when it comes to some of these stablecoin issuers. FDUSD, TUSD, BUSD. I don't know if those are one to one because they say that they are. None of them have gotten a PCOAB, whatever that investor.gov has just said, audit. And I know that they haven't because they've never genuinely gotten an audit done. Um, Obviously everything has been self-audit in crypto, or if we do get an audit, it's, months, even, periods of time away from the actual date that it would probably represent. So as the investor.gov document says right here. So what this tells me is there's still a good chance that a lot of the reserves for these stable coins aren't one to one. And this is something we've been talking about for a long time. And it's not necessarily fun to say this while the price is going up. It isn't. For 7 months, I sat in a position against Binance, shorting BNB. And I knew that at some point CZ would step down. I knew that he would either be charged with criminal activity or it would get to the point where he would have to step down as CEO. And obviously, both have happened. It just took time. Uh, Now, the scary thing here is Tether's the top trading pair across all assets in crypto. I mean, there's tons of Tether exchanges out there that is the primary trading pair. So if they aren't one to one, if we know that the issues that are on the Tron blockchain and the USDT that is backed on the Tron that is minted on the Tron blockchain aren't problematic, well then that means that if there is there's a run on some of these exchanges, we could see liquidity drain faster than anyone would anticipate, and prices could just come plummeting down. So when they say, yeah, the proof of reserves are there, we should definitely be questioning that because they aren't necessarily telling us that at this given time, if everyone were to withdraw everything, that everyone would be able to grab their assets and have no issues whatsoever. But we are seeing bottlenecking even post CZ, like they were freezing some of the withdrawals that people can grab. Some people are having problems with the Binance Pay card and the debit card. So yeah, that's I think that's a good place to leave it. Went through a lot of stuff today, guys. If you're not watching this on Friday, hopefully you can watch this on Saturday, catch up in increments. Went through the entire market. Yeah. So when I look at Bitcoin and all those Ethereum, obviously they're getting towards the end of their moves. Could they go up further? Absolutely. You know what? Before we head out, let's just look at CoinGlass one more time because CoinGlass is, well, we'll look at two things real quick. Damn, I'm terrible at this by myself. Let's go here and go to CoinGlass. Let's just look at the funding rates. Still red, guys. Everyone's going max long on this, in the short term at least. On the daily, I mean, it's just still red. 7-day, red. I mean, it's red across the board. It doesn't mean that people are shorting. It means that people are longing the shit out of this. Let's look at the liquidity map. Right here, let's go down here for the 7-day. And we can see across the board, there is still a little bit of liquidation to be had. I'm looking all the way to at least 46.7. That would be, take out roughly $1.53 billion worth of liquidation, or at least that's what worth of leverage there is out there right now. Could we go all the way to 48, 49, even 50? Yes, but at that point, is it worth it? We're at 170 billion or 170 billion, $1.7 billion worth of leverage that's out there as opposed to 1.54 or so. If we look at this back here, we're just going back to 39K. There's $7 billion worth of leverage that's currently sitting out there. All the way to 34. I mean, let's see if we can even see 34. Let's go to 30-day. Now we can't see 34, but back there, just imagine probably close to $10 billion worth of leverage that's out there to that point. So very scary stuff in when we look at the positioning and where liquidations lie and how everyone's going max long, it's just kind of building the liquidity way below in some of those price areas. And again, we haven't tested anything, so there's a good chance that if we hit one, we're going to just hit them all, unless they want to prolong it, right? They could just try and make this a slow bleed and liquidate everyone all the way down. But yeah, that's what I'm seeing on CoinGlass. Let's the last one. Let's just look at Fred. Let's go to Fred charts, and this kind of goes back to a lot of the liquidity. What is that? OCE, other lines of credit, other credit extensions, I think. Credit extensions, other credit. Here we are. Yep, this is it. Sorry, it's just so many charts in terms of that you need to watch for liquidity. I'm not going to talk about reverse repo today, but we could look at this. This is the OCE, other credit extensions chart. Extremely high post Silicon Valley and all those banking crises. Now we are at zero. So that's a ton of liquidity that's out of the system. If we look at this in millions of dollars, this is 228,217 in millions. I'm terrible with the numbers when we look at that. It's definitely in the billions. Let's put it that way. It's probably, I don't even have my phone on me right now, so I can't even do the math, but big number, guys, big number. And now it's drained completely. So if we know that's going down, and then reverse repos, I'm not going to get into it, but we're just going to look at this here. That's going down as well. We're going to see a lot of liquidity gone out of the system by next year. So that's how I'll leave it as. If you have any questions or anything, obviously leave them in the comments. I'll go through anything. Find us on Twitter. Everything's in the bio below. Best of luck. Have a great weekend. Don't worry too much about the markets. Obviously, try and just I don't know what I'm trying to say. Detach yourself from the markets. If you're watching this on the macro, obviously you can have an idea of what we could be heading into. If you're looking at this on the short term, obviously you're going to be a little bit more active. Just be safe out there. Not everything's about the markets. Good to plug away once in a while. That's definitely what I'll be doing this weekend. So I'll leave it at that. Everyone who usually watches the show, thank you guys. If you're new to our show, give us a like, thumbs up. Same thing I just said. Give us a shout out, share, or just follow us. Even if you don't like what we're saying, if you think we're perma bears, be my guest. Let us know in the comments. Other than that, take care, everyone, and we will see you guys Monday.